All right, let's get right into it. Today we're going to break down a really important metric in the business world, the sustainable growth rate. Honestly, it's one of those tools that can tell you so much about a company's real health.
You know, we all think of growth as a good thing, right? I mean, more sales, more customers, what's not to love? But here's a question for you. Can a company actually grow too fast? It sounds kind of weird, I know, but growing too quickly can seriously put a company in a financial bind. Think of it like a corporate speed limit.
And that's exactly what the sustainable growth rate, or SGR, helps us figure out. It's basically the top speed a company can handle using only its own money, the profits it's already making, without having to go out and borrow a bunch of cash or ask investors for another check.
So let's kick things off with Section 1, the corporate speed limit. This whole idea is about finding that sweet spot for growth, that perfect pace where a company can expand without flying off the rails.
Moving on to Section 2, measuring profit power. Before we can find that speed limit, we first need to pop the hood and see what kind of engine the company's working with. How good is it really at making money?
And that measure of engine power, it's called return on equity, or ROE. It's a fantastic little metric that tells you plain and simple how effectively a company is using the money its owners invested to churn out actual, real profit.
And the formula is just beautiful in its simplicity. You just take the company's net income, that's the profit after everything's been paid, and you divide it by the shareholder's equity, which is basically the owner's total stake in the company. So, let's walk through an example to make this super clear. Imagine our company here made a net income of $200,000, and the total shareholder's equity is $1 million.
We just plug those numbers right into the formula, 200,000 divided by 1 million, and we get 0.2, which is of course an ROE of 20%.
Okay, but what does that 20% really mean? Well, it tells us that for every single dollar the owners have put into the business, the company is generating 20 cents in profit. That right there, that's our engine power. Pretty good, right? All right, so we know how powerful the company's profit engine is. The second piece of our SGR puzzle is all about what the company does with those profits. Does it hand them back to the owners, or does it keep the cash to fuel more growth?
See, every company faces this choice. It can pay out some of that profit to its shareholders, we call those dividends, or it can reinvest that money right back into the business, hoping to grow even bigger. Our example company here decides to do a little bit of both.
And this decision gives us two key ratios. The dividend payout ratio is just what it sounds like, the slice of the pie that gets paid out. On the flip side, you have the retention ratio, which is the percentage the company holds on to put back to work.
Now, for our sustainable growth rate calculation, the one we really care about is this retention ratio. Sometimes you'll hear it called the plowback ratio, which is a great name because it's literally the profit being plowed back into the company. This is the fuel for our growth engine.
And figuring it out is about as easy as it gets. It's just 1 minus the dividend payout ratio. I mean, it makes sense, right? Whatever cash isn't paid out to shareholders has to be, by definition, kept by the company.
So let's jump back to our example. The company made $200,000 in profit and paid out $50,000 in dividends. That gives us a dividend payout ratio of 25%. Then we just do 1 minus 0.25, and that gets us our retention ratio.
So our company keeps 75% of its profits to reinvest. That means it's hanging on to the vast majority of its earnings to fund its future. And with that, we now have the second and final piece of our puzzle.
Okay, we've done all the legwork. We've got our engine power with the ROE, and we know how much fuel we're keeping in the tank with our retention ratio. Now it's finally time to put it all together and calculate that corporate speed limit, the sustainable growth rate.
And you're gonna love this. The final step couldn't be simpler. You just take the two numbers we've already found, that's your return on equity and your retention ratio, and you multiply them together. That's it.
So, for our example company, we're working with an ROE of 20% and a retention ratio of 75%. Let's do the math.
And there we have it. 20% multiplied by 75% gives us 15%. This is our sustainable growth rate. So what does this mean? It means our company can grow its sales by 15% a year using nothing but its own profits. No new debt, no new investors. That is its safe speed limit.
Okay, on to our final section, why this matters. So we have our number, 15%. But who cares? Why is this little calculation so important? Let's break down what it actually tells us.
Well, if you're an investor, this is huge. It's like a financial health check. It lets you peek under the hood and see if a company's amazing growth is actually built on a solid foundation, or if it's just being propped up by a mountain of risky debt. For managers inside the company, SGR is a total reality check. It helps them set growth targets that are ambitious but also achievable, without putting the whole company in jeopardy. And for any students of business, it perfectly connects two key ideas: how profitable a company is and how its choices about that profit directly shape its future. But maybe most important of all, SGR is a giant red flag. If you see a company growing way faster than its SGR, you know it's getting that extra cash from somewhere, and that's usually by borrowing heavily. That can lead to a serious cash crunch, and it puts the entire business at risk.
At the end of the day, growth isn't always what it appears to be. A company can look like a rocket ship on the outside, but the SGR helps us see if the engine is actually built to handle that speed. It really makes you wonder, doesn't it? Think about your favorite company. Is it growing sustainably, or is it secretly speeding towards a financial crash?